Welcome to the debate. Our focus today is the intense competition within the London flexible office market. Specifically, we're looking at how we should analytically define both value and, prime real estate status. We're dissecting two very compelling but fundamentally opposed offerings from our source material.
And that really forces us to ask a critical question, doesn't it? When you're evaluating premium flexible office space in London, does the superior functional utility, the massive scale, and the comprehensive amenity offering of a large city location, in this case 10 Lower Thames Street, does that truly outweigh the strategic prestige and bespoke service of a West End counterpart, like 25 Green Street in Mayfair? Especially when, and this is the key, the Mayfair option commands a higher monthly rate.
Exactly. And my argument is going to center on that efficiency and utility. I contend that the sheer scale, the integrated features, and the competitive pricing of the 42,000 square foot property at 10 Lower Thames Street make it the definitive superior investment for any modern, growth-oriented business in the city.
And I'll be taking the opposing view. I mean, for certain businesses, value is just not linear. I'm going to be arguing that the critical importance of location prestige, the strategic leverage that comes with that W1K postcode, and the superior operational service in Mayfair, they fully justify the premium price and the, yes, smaller scale.
Well, when I look at 10 Lower Thames Street, I see a model of functional excellence. Value here is quantifiable, through capacity and breadth of features. We are talking about 42,000 square feet of newly refurbished, fully furnished space. Private offices, co-working, the lot. And it's right in the absolute heart of the city, next to Monument and Bank. Critically, this space is just packed with amenities. An on-site gym, an on-site cafe, cycle racks, showers, a substantial roof terrace with, frankly, impressive river views, and a dedicated fourth floor event space, all for £600 per calendar month. The functional utility per pound sterling is, I'd say, unmatched. It's an investment in scale and employee welfare.
I do appreciate that perspective, and it relies very heavily on those internal, tangible metrics. But value in prime London real estate is so often measured by external, intangible capital. 25 Green Street in Mayfair, it's a very targeted boutique offering. 7,000 square feet, designed specifically to house businesses of up to 25 staff, and it costs £650 PCM. Now, that £50 premium, it's not for square footage. It's the cost of brand equity. This is prime Mayfair, surrounded by high-end retail, fine dining, and it's near Bond Street. The operational commitment is clear: a manned reception, 24/7 access, and a high-end lounge with a coffee facility. This model, it prioritizes a seamless, exclusive client interface over sheer internal capacity.
Okay, but let's drill down into that £50 differential for a moment and the physical sacrifice it represents. We are comparing a massive 42,000 square foot facility, a genuine corporate campus, with a 7,000 square foot boutique space. If a business is prioritizing, rational capital deployment, it is paying over 8% more per month for 83% less space and a profoundly diminished set of amenities. To me, that just looks like inefficient capital expenditure. And what's more, the city location, right at the nexus of the Central, Northern, and Jubilee lines, offers far superior accessibility for the vast majority of a modern workforce compared to the West End.
But that assumes all square footage is created equal, which, in a commercial context, it most certainly is not. You're valuing the 42,000 square feet based on its utility for internal staff. I'm valuing the 7,000 square feet based on its utility for external client conversion for, let's say, finance houses, wealth managers, luxury consultancies. The W1K7AX postcode is not some vanity metric. It's a critical component of their perceived market valuation, their credibility with high net worth clients. That location acts as a screening mechanism, providing an intangible commercial leverage that a very dense, large city campus, regardless of its transport links, simply cannot replicate. That £50 premium is the cost of alignment with the highest echelon of London commerce.
I see where you're going with brand alignment. I do. But let's consider the staff experience. That alignment comes at the expense of comprehensive wellness, doesn't it? The 10 Lower Thames Street property, with its on-site gym, showers, cycle racks, and cafe, it's a functional ecosystem. It's designed to maximize staff presence and productivity within that environment. We all know that retention is a key cost driver for any modern firm. So why would a company intentionally forgo those significant integrated lifestyle features, features proven to boost retention, just to gain proximity to some high-end shops in Mayfair?
I have an interesting quantification of value, framing amenities as a retention tool. But I would argue that your list of amenities, the gym, the cafe, the roof terrace, is heavily weighted toward internal perks. They're features that primarily benefit the employee after they've been hired. My argument is that 25 Green Street prioritizes essential operational service and grand protection right up front. The manned reception, the 24/7 access, the dedicated high-quality meeting spaces. These are non-negotiable for a premium business. So which is a more critical strategic investment? A dedicated professional ensuring every high-stakes client is greeted flawlessly, or the option for an employee to use an internal gym?
I think you're framing those internal amenities as secondary luxuries when, in fact, they're becoming strategic necessities in today's talent landscape. The city market is fiercely competitive for young professionals. Offering a fully integrated wellness solution, the on-site gym and showers, is a powerful differentiator. And furthermore, the massive size of the 10 Lower Thames Street facility allows for scale features, like what the material calls the awesome fourth-floor event space. This lets companies host major industry functions, all-hands meetings, significant client launches, all within their own facility. That creates community, and it cuts external venue costs. That is functional efficiency at a scale the Mayfair office just cannot facilitate.
I'll concede that hosting large internal events offers cost savings, but you're still primarily focusing on internal cost avoidance, not external value generation. If a firm's main income stream comes from high-net-worth clients, clients who value discretion, high-touch service, and exclusivity, then the city campus actually risks diluting that perception. A 42,000 square foot building is inherently multi-tenanted, it's high traffic. The boutique nature of 25 Green Street offers a controlled, focused environment. The firm that chooses Mayfair is paying for quality control, for the assurance that their brand isn't diluted by a sprawling campus feel.
You speak of quality control, but I'd counter that the massive capacity of 10 Lower Thames Street ensures growth control. The all-inclusive flexible terms mean a business can rapidly expand from, say, 20 to 50 employees without the hugely costly disruption of a forced relocation. The 7,000 square foot limit, designed for up to 25 staff, imposes an artificial ceiling on adaptability. Flexibility is the core selling point of these products. A facility that forces you to move the second you hire your 26th employee is fundamentally inflexible, regardless of its postcode. That potential for high churn is a profound financial risk.
Well, that perspective is rooted in the assumption that all high-value businesses are chasing that kind of explosive, unconstrained growth. Many premium service firms, specialist law, boutique capital advisory, they operate lean intentionally. Their strategic goal is focused profitability and maintaining exclusivity, not just maximizing headcounts. For them, paying the £50 premium to ensure they remain within a 25-person cap guarantees that the environment stays exclusive and focused. That boutique scale is a deliberate strategic choice, ensuring the atmosphere aligns with the high-touch service they provide.
But that exclusivity, that Mayfair lifestyle, it comes with its own inefficiencies. You highlighted that the Mayfair district itself acts as the amenity zone, the high-end restaurants and cafes. Well, that requires staff to leave the building, consuming valuable time, increasing the cost of distraction, and demanding higher external spending. 10 Lower Thames Street offers an on-site cafe. An on-site cafe minimizes travel time and it keeps the workforce localized and productive. We're trading a 10-minute walk for a convenient Lyft ride. That accumulated time saving across a large workforce translates directly into productivity gains that I would argue far outweigh the prestige of dining near Bond Street.
I understand the utility calculation. I do. But I think you're miscalculating the psychological value of external choice. The staff at 25 Green Street aren't reliant on a single, potentially institutional corporate cafe. They have access to the highest quality, most diverse selection of dining in central London. This acts as a benefit in kind, a daily validation of their prestigious location. And let's also consider the technical aspects. The Mayfair property explicitly mentions a manned reception and 24/7 access. That implies a higher level of dedicated security and professional interface. In a huge 42,000 square foot environment, the reception is often spread across multiple entrances or delegated to general building security, which can dilute that critical first impression.
I'd argue that a modern refurbishment like 10 Lower Thames Street, situated in the financial district, inherently incorporates robust security and professional front-of-house operations. The key difference remains the integrated infrastructure. The city location has cycle racks, showers, a gym, features that speak directly to the post-pandemic requirements for sustainable commuting and employee well-being. The Mayfair location's focus on 24/7 access and a manned reception is foundational, yes, but the city's comprehensive utility suite is what future-proofs the tenancy. It addresses the changing demands of the workforce, not just the static demands of a high-end client base.
Future-proofing for a high-end firm is often about maintaining market position and client trust, not accommodating every possible lifestyle feature. We need to analyze this price difference not just as a cost per square foot, but as a function of the external area yield. Mayfair property inherently commands a scarcity premium. The supply of prime boutique 7,000 square foot spaces is extremely limited, and the demand from high-status tenants is constant. The city, whilst prestigious, offers a much higher supply of large-scale flexible working solutions. So that £50 premium for 25 Green Street is arguably just a reflection of market mechanics and asset rarity.
That analysis of market rarity is compelling, but it forces us back to the question of who pays the cost. If the asset rarity drives up the price, that cost must translate into a measurable business advantage that exceeds the operational and staff welfare benefits found in the city. I still struggle to see how the Mayfair address provides a tangible, daily competitive edge that justifies sacrificing the scale you need for adaptable growth and the integrated amenities you need for retention. The 10 Lower Thames Street facility is built for maximum operational efficiency, capitalizing on its scale to provide superior features at a lower price. It's simply the superior economic proposition.
I think you're defining superior economic proposition too narrowly, focusing only on internal cost control. The proposition from Mayfair is about maximizing perceived brand capital, which is critical for securing high-value contracts. If you save £50 a month on rent, but that city address causes a prospective client to opt for a firm they perceive as more prestigious in the West End, well, the loss of that one contract vastly outweighs any savings you've made from scale or an on-site gym. For the Mayfair tenant, the office is a marketing tool. It's an extension of the CEO's calling card, not just a desk farm.
But that marketing tool, that external projection of prestige, it's underpinned by staff who must be retained and must be productive. If the environment fails to support their health and well-being, if the commute is difficult, if there are no wellness facilities, that prestige becomes hollow. The city location offers massive transport hubs, built-in wellness, and large social spaces like the roof terrace and event space. It's a holistic offering that supports the entire life cycle of a growing company, from talent acquisition right through to major corporate events. It's the utility champion.
But the Mayfair location doesn't preclude staff wellness. It simply relies on the highest quality external market to provide it, prioritizing focus and exclusivity within its 7,000 square feet. It provides the essential operational infrastructure, manned reception, 24/7 access, and it delegates the rest. It's a lean model that minimizes the facility footprint and maximizes the impact of the location.
Ultimately, my position is rooted in tangible, future-proofed utility. 10 Lower Thames Street offers functional depth, massive capacity at 42,000 square feet, and an extensive range of modern amenities, the gym, the event space, the river views, all delivered at the lower cost of 600 PCM in a prime city location with unbeatable transport links. This is the clearest definition of value for a scalable, modern organization.
And I maintain that for businesses where client perception and strategic positioning are absolutely paramount, where the office functions as a statement of success, the critical factors are location prestige and the dedicated high-touch service infrastructure of 25 Green Street. That focused quality justifies the smaller scale and the 650 PCM price point, ensuring that the W1K 7AX address signals exactly the level of excellence the tenant requires.
It is clear that the source material presents a profound, high-stakes trade-off.
We are looking at two successful, yet totally divergent investment strategies in prime London.
Indeed. And the choice hinges entirely on whether a business calculates prime London value based on internal, scalable utility and integrated employee features, or on external brand capital and focused exclusive operational service. There are incredibly strong commercial and strategic arguments supporting both calculations.